Well, good morning, early birds, and welcome to our first roundtable session of the 2015 calendar year, our January roundtable. I'm joined here by my friends Ken Kavula, Cy Lynch, and Hugh McManus. My name is Mark Robertson, and we're also joined here by fellow Manifest Investing partner Kurt Kowitz, our technical manager, so he's listening in for a few things. Welcome to the new year. January has been relatively unkind to investors, but we're going to go on a hunt or a search for opportunity here this morning. I've asked the guys to think about perhaps sharing a few thoughts about their favorite methods or techniques for discovering opportunities. We do that on a monthly basis, but we just want to kind of reinforce that a little bit here today, and let's go ahead and take it away. Just a quick commercial for our groundhog. You know, this time of year is really a massive celebration for us at Manifest Investing. It's our 10-year anniversary this weekend, and we also just have a whole lot of fun. One of the things is our stock picking contest. We'll probably talk a little bit more about that later. We refer to it as the groundhog. But first, here's a quick look at our legal beagle paperwork. Again, everything we do here is to illustrate or demonstrate principles and a process that have worked for over 7 decades in long-term investing. So you'll hear us talking about real companies in real time, putting those analysis techniques to work on, in this case, 4 companies here today, and sharing our thoughts and assumptions and judgments about those companies with you. Everything that we do is an educational demonstration, and as it says right up there at the top, no investment recommendation whatsoever is intended. If you want to be placed on a reminder list, I believe Natalie sends them out a couple times a month. You can write her at nkavula1@comcast.net down at the bottom. If you have any questions, my email address is there at the bottom also. Here's a quick look at our standing agenda. Again, many of you are returning. Big hug to you. If you're joining us for the first time, we do keep this fairly wide open. The floor is open for questions, and we will be closing with a Q&A session towards the end. One of the things I'll probably be demonstrating, more than probably, I will demonstrate some of the things that Kurt is working on here lately, including our alerts function for some stocks. So we'll take a look at those, but this is our standing agenda for every monthly meeting. We're going to take a look at a few favorite screens, some results, really nothing on the hot seat as far as the challenge this month, and then there's our 4 tickers that we'll be presenting as far as the quick case studies for our stocks. Here's a quick reminder as to why we do this. We basically are coming and bringing what we feel may be our, one of our best investment ideas currently. We do keep track of how those ideas do over time. We'll take a look at that here in a second. Our objective is to beat the market by 5 percentage points. That's 500 basis points. And we fully recognize that that's an ambitious goal, and we'd be happy with anything above 0, but we really are aiming for 5%. We would like to see roughly 3 out of every 5 selections outperform the market over the long term. Here's a quick look at how we've done. We've been doing this nearly 5 years now, and our selections have actually outperformed the market by a fairly modest amount. We've taken a couple pretty good hits here over the last year. Every single time we make a selection or the audience votes for one in a poll, we basically invest $1,000 into that and then track it. We'll be looking at that tracking portfolio here in a second. But we keep track of every single thing that comes before us as we have over the last 5 years. You can see about almost 50% of the selections have actually outperformed the market, and that red dotted line is the objective to get to. We think we will at some point approach that line again. I think we can all agree that the overall trend is in the right direction at least, even if it seems to be plateauing out a little bit. Here's a look at the 20, I believe it's about 20 most commonly chosen selections that we've made over the years. This is from the tracking portfolio. Again, you can see the entire tracking portfolio using that link at the bottom of the screen if you want to do that on your own. That's a public link. You do not have to be a Manifest Investing subscriber to access that. But some pretty nice names top to bottom. Anything reach out and grab you guys other than Cy is not picking, newsflash, Cy is not picking Cognizant Technology this month.
Well,
that is news.
I think it's been a great performer. It makes up a significant piece of my personal portfolio, and there's a lot worse stocks we can pick than Cognizant.
So we're kind of teasing Cy a little bit here. The numbers in parentheses there are the number of times each one of those has been chosen. So when you look at Cognizant, you see a value of $15,900. That's basically $11,000 turning into that. And while many of you were wondering about Cy picking it 3 or 4 times last year when it was down in the doldrums, it's actually come back quite nicely. It's one of the better performing stocks in the stock market over the last 6 to 9 months. So that's one of the reasons it's carried to the top. Apple, I selected Apple 3 times over the last 18 months, and some of you gave me a hard time about that. So I'll take it. And, how about BioReference Labs, guys? 5 selections, fairly obscure stock, now up to about $8,400.
Yeah, I think the only loser on this list here is Qualcomm right now, and it's not losing by much.
Yeah, and I regard that as a fleeting temporary condition of opportunity, really. So anyhow, that's top to bottom, and again, you can check out the entire list. Some of those are pretty sensational. You look at that PRA group towards the bottom, 2-time selection. That's actually the old Portfolio Recovery Associates, renamed, and that's actually done pretty spectacular.
Well, the one above it also, Mark.
Yeah, I was going to say I have not. I know ResMed was kind of running up some, but that looks like up a bit more recently than even I was aware of.
Yeah, ResMed is the anti-snoring company. Ken presented it probably about 4 years ago. So
yeah, it was one of my really early picks, right?
Mm-hmm. Yeah, and I think I believe the second one is mine probably about 2 years ago. I know I've got it in a number of portfolios. I think I presented it here, but Ken was the originator.
And even if we can tip our hat to Hugh McManus and some of his less conventional picks from time to time. Bank of America, back when everybody was holding their noses and refusing to invest in it, he picked it 4 times, and that's up a pretty healthy advance. So.
Yep, and Staples is another one.
Yeah, Staples is hanging in there pretty nicely. So every once in a while we do select some creative stocks. All right, I thought I would spend just a moment introducing a topic. I know the guys are all going to at least comment to this and cover them, but actually ran into some pretty interesting reminders of some stock selecting methods that we use. So what I thought I would do is jump over to Manifest Investing and just share with you guys, and I'm actually going to put this out as an article that will be available to the broad public also. So if you'd like to see this after the session and you're not a Manifest Investing subscriber, go ahead and drop any of us a note, and we'll be happy to point you to a public link. But it's a time of year when we do our shopping for the Groundhog Contest, which is 1 year ending and another one beginning this weekend, and actually went and just kind of reached out to a number of different screening techniques, and you see them listed here. And some of these get kind of interesting. There's the top 25. You can see why I selected Qualcomm. More on that in a few minutes. But again, we often share these type of screens with you. There's the ivory soap screen. This is one of the reasons I thought it was dangerous for Cy this week or this month, because that's still pretty high on the list as far as fairly attractive candidates for study. So there's the ivory soap screen for this month. One of the things that I also noticed, and this is a theme that Hugh will be talking about, is the construction and infrastructure and all of that type of stuff. Well, many of these type of companies like Quanta, even General Electric started appearing on some screens here recently. So it's kind of neat to look at some of these.
Mark, I think what else has begun to appear is this fight that I think is going to go on for the next 2 or 3 years between content and delivery of entertainment products. For the first time ever, we had for the first time in my memory, we had an entertainment company come up into this ivory soap screen, this Discovery Communications right here. And I think this is going to be very interesting to watch to see who wins out, whether it's going to be content providers or whether it's going to be delivery companies like Comcast, or whether it's going to be companies that kind of try to do both like Discovery Communications. A very interesting company to take a look at.
Absolutely. And, here's one that we probably ought to reinforce from time to time. Ken, would you like to spend a few words talking about the triple play screen?
Yeah, this is coming from work from George Nicholson quite a while ago. In fact, if you check some of the older investor manuals from Better Investing under the older name of National Association of Investors Corps, NAIC, you'll find this triple play idea. And essentially Nicholson was saying that if you could find a stock that exhibited these three particular characteristics, you had the chance of really finding an undiscovered treasure among the list of stocks you were looking at. The first thing was that it should have a depressed stock price, and the way that we can look at a depressed stock price is on that number 1 right there on the Qualcomm page, essentially looking for total returns that are at the high end of what we might expect for the different sizes of companies. So when I'm looking at a large company like Qualcomm and I'm seeing a return in the 9 to 14% range, that's indicating that the stock price is a little depressed for what we're talking about. The second thing is the chance to grow the PE ratio. So you compare the current PE ratio, and that's at the top of the page. It's based on that recent price number that's right next to it. So they vary week by week. If it's an older value line, get a newer PE ratio to compare, but comparing the current to the projected, and if you're looking at PE expansion, then that's leg 2 of the triple play, and then leg 3 of the triple play is the possibility of increasing the net margin. So we're going from 2013 on the net margin line, net profit margin right there, and we're seeing around 32% to the projection up at about 33.5%, and there is an increase, although I do notice that a lot of that increase is baked in for 2014, 2015, and Value Line's actually predicting a little bit of profit margin contraction from 2015 to the 3 to 5 year range. So you hit these 3 milestones and you've made a triple play, and you stand to have a company that really or that possibly is going to give you superb returns outside what you would consider average. That's certainly an interesting list, isn't it, Mark, that you've pulled together there?
Yeah, and I mean, I'll be talking about Qualcomm a little bit later, but many of the companies that are on this list have been selected for the roundtable or featured in a number of places. And these are companies that, and they're not real strong qualifiers. As Nicholson pointed out, sometimes it takes a bear market to produce opportunity, and something that he likes to talk about. There aren't a lot of companies that meet the criteria, but Ken recently featured Copa Holdings. That's the Latin American airline company. Fossil's been selected.
In fact, Mark, that was my second choice to double down on Copa this month. So I'm pleased to see it rising to the top of a list like this.
And you can see the one that Cy's going to cover, ticker symbol MSM, made the list also, and it's actually one of the stronger triple play candidates, and that's, again, he'll probably be talking about the opportunity for margin improvement. Just a few other things that we might want to go through. One of the things we have a lot of fun with our groundhog contest, and we like to celebrate the fact that our broad assets ladies and gentlemen from St. Louis have won it the last couple of years. They basically have won it with a fairly unconventional pick of Lynette, ticker symbol LCI, and we featured this in this Victory by Escape Velocity article middle of the year. I really think that it makes a lot of sense if you really believe that stock prices follow earnings to perhaps look for opportunities where earnings are expected to increase dramatically. And you can see Lannett at the top of that list. And those are year-over-year numbers that you're seeing, for 2015, 2014, 2013. You can see Lannett had a very strong breakout. But again, there's nothing even close to that magnitude anywhere. We looked at 6,000 companies. There's nothing really close to of any magnitude, but what is shown there are companies that have had increases in each of the last 4 years and could be worthy of a quick study. There's a Walter Schloss screen I'm not going to go into right now, other than to point out that I had forgotten two things about Mr. Schloss and what he used to do. He liked to see that current share price within 10% of its 52-week low. More on that later from Hugh. The other thing that I had forgotten is he refused to invest in financial sector companies. And I think we're going to take a closer look at that. He just simply abhorred them. And it'll be interesting to see how that shakes out. Now, many of us and many investment clubs also kind of avoid that financial sector for many reasons, including complexity. But he shunned it pretty heavily. There's a Piotrowski screen, a little bit of cash.
Worth looking at.
Excuse me, Hugh?
No, Piotrowski it's a really interesting screen he developed when he was at Chicago. I think he's now at Stanford or Berkeley, but yeah, Stanford. But yeah, I mean, all these just show value investing, and with the exception probably of Piotrowski, many on the list are direct descendants of Benjamin Graham, or Graham as he would be called.
Absolutely. Yeah, the one that kind of caught my attention on here was Golfmark, ticker symbol GLF. It actually showed up in a couple different places. Some of these are pretty obscure, and some of them definitely fall into that deep turnaround mode, but every once in a while I think you can find a pretty interesting idea when you're in that deep value hunt. So we're taking a look at some ideas from the caps, and then I put together a modified McManus for this weekend. Hugh kind of sticks to a fairly short list of favorites, and taking his techniques and applying them across the broader universe, those full 6,000 companies available in the Value Line database, you get I think a really fascinating list of companies. We were sharing notes earlier this morning that the average company now is in that 25 to 30% range, comparing versus its 52-week low price.
Yeah.
No idea what the average is, and many of his favorites, including you can see MSM makes this list. Qualcomm is on this list. ABB, one of Matt Spielman's selections a few months ago, is near the top of this list.
McDonald's is down there.
McDonald's. Just some fairly interesting names. And again, these are all companies that have financial strength ratings of, with the exception of BP and Vera Bradley, B++ or above, and a fairly decent return forecast. And this is using all the Value Line inputs, so that's why there'd be a slight difference on the par from the manifest par, which is a consensus forecast. This is Value Line only. And you can see that some fairly interesting numbers there, top to bottom. Again, I think we're pouring over.
Mark, can you do just a walkthrough through that column that you've highlighted in yellow? Does a low number, is that what you're looking for, or are you looking for a high number when it comes to versus 52-week low?
Same technique as Hugh. Hugh, do you want to give a quick description of what you're basically looking for there?
Yeah, it's just the ratio of the 52-week high to low, and then you look at the current price versus the low price. So you're really saying if there's a ladder going from low to high, what percent of the way are you to the bottom of that ladder? How close are you to the 52-week low? And the Deckers is within 0.5% of its 52-week low. So for me, all else been equal, so it has to be a quality company that would show signs of long-term growth, etc., then I want it to be as low as possible. Kind of a lazy way of doing it.
Here's an interesting question from Julie out in Georgia. She'd like to know, is there an approximate time that it takes these companies to recover? Do you Do you have a time limit? How much patience do you have? Should it take a year? Should it take 3 years? How long should it take for these companies that are at their lows to recover?
Well, I mean, for me, it would be ideal if they'd stayed there for 25 years and then recover. I mean, because I'd like to buy companies with the intent of keeping them for many decades. So I'm extremely patient. Yeah. So.
And when they move to a high, do you sell or do you just continue to hold, Hugh?
With very few exceptions, I continue to hold. It has to be a ridiculous high where the PE ratio is pretty much out of control and people really want it. And I just find it really hard. I mean, it's a flaw, and I think a good flaw that many of us in the better investing / manifest investing community, the long-term investors, have, which is we don't like to sell. I mean, I jokingly say when we buy a company that on the brokerage screen it should say, I take this company to be my lawfully. So just don't like it. And of course, we're not monogamous with companies, otherwise you wouldn't have a portfolio, but like to hold it for a long, long time.
Yeah, I think, when people question some of the selections, some of Hugh's more creative selections, you guys just have to realize he has a huge amount of patience. More than, way, way, way more than the average investor and way more than most of us. So, he's looking at, he's not thinking about ExxonMobil over the next year or 5 years and even 10 years. You heard him say it. He's thinking 20, 30 years for a company like that. And, I so vividly remember our discussions about Bank of America. His whole thesis was this company is probably not going to disappear from the planet, and I can get it for $2 a share, It's just an example of, maybe a little bit of speculation, but speculation on a very long-term horizon and quality prospects.
Hugh, Ron is asking a clarifying question. He thinks he has what you're doing, but he wants to know, would it be especially interesting to look at a company that's reached a brand new 52-week low?
Yeah. I mean, I list them, and, the companies that are closest to their 52-week low come to the top of this list that I have. I don't always buy the one at the very bottom, but yeah.
And ideally, a company at a 52-week low would have a number in this column that's highlighted yellow, then the number would be 0.
Correct.
Well, the way I do it, it goes negative, but yeah, so it goes bright red, so it's very clear.
All right, let's go ahead and press on. We'll close out this section. I just wanted to do one quick reminder of one of our favorite things to do. We'll probably do a little bit more of that as this weekend continues, and I continue to hunt down my absolute can't-miss winners for the 2015 Groundhog Contest. This is an example of a fund that we think has a pretty good head on their shoulders. It's the Buffalo Growth Fund, ticker symbol BUFSX, and the team leader there is Kent Gassaway, and we've talked about him here in the past. He thinks and talks just like us. His turnover rate is approximately 20%, so the fund does not turn over ideas very rapidly, so it's pretty committed. And what I've done here is just gone to Morningstar.com, and I'm using the premium version here, but just exported a list which gives the most recent buy decisions that they've made. And they've recently invested into Wisdom Tree Investments. Lifetime Fitness is an interesting one.
Mm-hmm.
Again, this is just somebody who has that Hugh McManus very long-term perspective, in this case with small companies. And there's one there. I really don't know too much about the company, this Kythera Biopharmaceuticals. Do you have any light that you can shed on that, Hugh? The only thing I know about them is many of the leaders of that team are the guys who came up with Botox and a couple of things like that.
Yeah, it's a really interesting company. It's up near Thousand Oaks. Many of the people in top management are former Amgen folks. They're targeting small molecules rather than proteins or large molecules, that is kind of Amgen supporting. But they have, I think, a decision. It's called a PDUFA date, but a decision by the FDA in a few months for their lead drug. I think it's in April. But it's a very interesting company.
Is that the one for eliminating the double chin?
That's the one, exactly.
Okay.
Yeah.
That's the type of company we're talking about, gang, and It's one of those companies, if you try to do a stock selection guide on it, it's one of those Hugh McManus companies where there won't be any E's. So we'll probably spend a little bit of time talking about it. But, this kind of takes me back to my early days with the investment club stuff and a company by the name of Aguron Pharmaceuticals.
Oh, yeah.
And, Hugh, why don't you tell the rest of the story, Hugh, because that was a company that didn't have E's either at the time.
No, it didn't. But the interesting thing about Aguron is that they reached out very aggressively and very atypically, I think, to individual investors and clubs. So I think they went to many chapter events and certainly all the national events. It wasn't called BINC at the time, but the National Congress. This was in the 90s. And to CompuFest as well. There's a word we don't get to hear enough about. And the company actually had what's called a protease inhibitor, so it was one of the very early anti-HIV drugs, and it was a very effective drug and sold very well. But the stock was trading, the company was worth maybe a couple of $100 million. Many clubs were buying it, and then Warner Lambert moved in and bought it for just over $2 billion, so a lot of people got a very nice return on that. I think you ended up, I can't remember if you ended up with cash or shares, but of course Warner Lambert ended up being Pfizer, and Aguron ended up being Pfizer La Jolla. And the interesting thing is when you go visit pharmaceutical companies in the San Diego area, a disproportionate number of people have their pharmaceutical pedigree from Aguron and are shocked when you remember this company.
Mm-hmm.
A lot of individual investors have very fond memories of it, and unfortunately it was bought. I think it was bought really cheap at $2 billion back in '99. Very interesting company.
Well, one of the reasons I bring it up is this, again, ticker symbol KYTH. It doesn't fit the mold. It's very unconventional, very early stage, but I think we'll probably watch that one just kind of as a special case and watch for some updates from Hugh and maybe a little bit of a refresher on how to watch the PDUFA stuff also.
And just in my own defense, a very small percent of my portfolio is invested in these highly speculative companies. So if they go to zero, and there are examples where they do, it doesn't do a lot of damage, but the upside can be actually quite phenomenal.
All right, any other comments on screens, guys? I know that some of you have content in your stock presentation, so I think we can just go ahead and move on. Any other thoughts?
Yeah, I just want to indicate, Mark, that you don't have to use a lot of different screens. I manage most of what I manage in my portfolios by just sticking with manifest investing and the screens that I can generate right from there. I know Cy's going to talk about a few screens, and I'll chime in on where I'm with him and where I'm a little bit different from what he does, but essentially I'm investing the same way Cy is by using just simple manifest investing screens.
Okay, let's go ahead and press on. Cy wants to talk about tools and that type of stuff today. So,
all right, thank you, and good morning, everybody. I will, like Mark's been saying, I'm talking about MSC Industrial today. That happened to be the Solomon Select Feature stock for the January 2015 manifest investing newsletter, so you may want to take a look at Mark's write-up there on MSC. Also, I featured it back in the October 2013 Better Investing magazine, so you can take a look at that article as well if you want to learn a little bit more about the company. But as Mark, I think, has already alluded, MSC is in the industrial supply business. Kind of an acronym or buzzword that they use in their information as well as some of the analysts is MRO. And that kind of confused me at first, but that just stands for maintenance, repair, and operations. So it's essentially all sorts of supplies that industrial customers need to do their business. That's going to be fasteners like Fastenal does. It's going to be tools and that sort of thing that any sort of industrial customer needs. Their focus is primarily on the small and mid-sized customers. They're essentially the business model, and what MSC seeks to do is to aggregate smaller customers that don't necessarily have a whole lot of purchasing power or a lot of size to do extensive shopping for their supplies and what they need to do their business, as well as link them with sellers of the products that don't necessarily want to have their own independent sales forces and direct links to the consumers. One thing that's pretty amazing about the business is that it's very fragmented. I believe Morningstar says that the top 50, that's 50, distributors only have about 30% of the market. So there's a lot of room for a company like MSC to grow. Those of you familiar at all in the area maybe have heard of Grainger. W.R. Grainger is probably the largest, I don't know for certain, but probably the largest company in this area. But that's what MSC does. What I wanted to focus the rest of my presentation on is how I got the company, my favorite screen. Ken already kind of alluded to it, and then just walk you quickly through how I came up with a valuation for MSC. And I'm going to go ahead and confess that I am probably even less of an investing hobbyist time-wise than I used to be. As you know, over the years, I have spent various amounts of time with my investments, both personal and investment education efforts. At times doing it largely professionally, investment advisor, and working very actively with Manifest. The last few years, I've pulled back a lot of that because I've gone back to school, some of you know, and have also entered the ministry. So I really, both my personal investment and investment education, I have a lot less time than I've had before. And so it's always interesting to see how these tools that we've been using can really work in a very simple and non-time consuming fashion. So that's kind of what I'm trying to pitch today for you. Here is my favorite screen of just about any sort, and it's a Manifest-based screen. And you can see the criteria on the right-hand side of the page. I usually pick something a little bit below par, or excuse me, not below par, below my par plus 5, a little below the sweet spot, just so that we catch companies that may be right on the edge of the sweet spot. You see when I pulled this screen, 12.2 was the bottom of the sweet spot, and so I chose 11% as my lowest par. Always looking for excellent quality companies, so I plug in 80. My financial strength, for a good while I've been using 80, which again is a very high standard. That varies somewhat depending on the market. In a bear market, I'd be willing to let that slip certainly to 70 to increase opportunity, possibly even as low as around 65 or so. But right now I'm pretty set on the 80, and then sometimes I throw in earnings stability, sometimes I don't. A lot of times what I will do is do just the basic screen and then rank by EPS stability to take a look at it. And you see here some pretty interesting candidates. QUALCOMM, which is going to be mentioned today. You've already heard about Cognizant, is on there. And then MSC Industrial Direct, as you can see, is very near the top of the sweet spot for these companies. And I was kind of looking in the sweet spot area, and I chose not to do T. Rowe Price and Jacobs, partially because T. Rowe is in the portfolio, and Jacobs, I believe, is also, and I just wasn't real interested right now in looking at oil field exposure. So I decided to choose MSM. Let's move to the next slide. Here is the stock selection guide. You see a 10-year history. Because it is an industrial supply company, it does operate in somewhat of a cyclical industry, and you see some impact of that although you see the general trend is strongly up for MSC. And in the spirit of simplicity, when you've got a company, and MSC, you have to realize, has been in business for over 50 years. So this is not a new company by any stretch. Its predecessors date back a long ways, and it's been around a while, and it has seen a lot of changes and challenges in the business cycle. So I just chose, since I don't have any real ability to go much different than historical, I decided to go roughly with the 10-year historical average of growth. Since we maybe are a little bit near the maturing phase of our business cycle, although that's very debatable, I decided to go a little under it. I just chose a sales growth rate of 9%. Next slide. I always use the expected income statement or preferred procedure method, which is how Manifest Investing also does earnings per share from the growth figure. And here you see off the stock selection guide or off the toolkit my expected income statement. And again, I decided to go with the 5-year averages all the way through because, again, you've got a little bit of a business cycle, but didn't want to play with it too much, as sometimes you need to do with cyclical companies, because MSC is still a growth company, although in a cyclical industry. And so you see the decisions that I made. I used the value line diluted share figure of 60.8, and that gave me a $6.97 figure out. Kind of file this away in your mind. We'll come back to it in the last slide and convert it all into Manifest, and also talk about how it compares with the analyst consensus figures, and also mention a little bit about triple play on the last slide. But that's where I got the earnings per share from. Next slide. This is just the sections 2 and 3 of the stock selection guide, and again, you can see the pre-tax profit margins vary somewhat. It's a low right now, 13.6, and actually the trailing 12 months is 13.3. So you can see some expansion possibility just coming back to the average, and you also see that in the 17 range is not unusual for the company, and in fact Morningstar is projecting that it will get back to the 17 range. So I already cheated a little bit. There is one of the triple play possibilities for MSC. I won't comment on this slide too much about the PE ratios. Let's move to the next slide. Interestingly enough, when you have a company that has a steady historical growth, and I'm not anticipating any major changes up or down, I take a look at the PEs, and notice here there's not a whole lot of change. They've been relatively consistent over the last 10 years. Astoundingly, in a company like this, I frequently like to use the medians for my projections. Notice the 10-year medians, that's the middle of the 10 years. You can see on the top line, and then down at the bottom of this screen, you see the averages, which is just a simple average. Notice the low PEs are identical, and the average highs are very close to the same. So I chose to use the 10-year medians on my stock selection guide, which is the next. And that leads me to an average PE of 19.5, which gives me a projected average return of 14.1% over the next 5 years, potentially, using those judgments. Next slide. And this is the slide that I will close with. It's both my last one, plus it's going to kind of tie it together as I just promised. This is the Manifest Investing Eagle that you can use under my stock studies. It's essentially moving the judgments that I made on the stock selection guide over into the Manifest format, and you can see I've used 9% sales. Consensus is about 10.5%. Morningstar's a little bit higher than that. Value Line's a little under that, but you've already heard my explanation for choosing the 9%. Notice the net margin. You saw where I used pre-tax margin and tax rate, but that converts to a 9.7 net margin, which is a fairly significant increase from the current 8.1%. And again, that's not quite as aggressive as either Value Line or Morningstar is. Consensus is around 10.1%. So that is one of the triple play, and probably I think two of the three triple play characteristics are met well by MSC, and that being one of them. The PE ratio is the other one, and you notice here it's roughly flat. We're showing a 20.1 PE ratio. I'm projecting 20.5. Consensus is around 19. So that's there's not a whole lot of room there for PE expansion, which is the part of the triple play I don't think really fits. And then, of course, there's the depressed stock price, which we're in a general up market with the stock market hitting highs. However, as you saw in the modified McManus screen, MSC Industrial is very near a 52-week low and is somewhat concerned over the global economy has depressed the stock price. So I think you have a little bit of a depressed price, although it's not a bear market depressed price. It's kind of industry-specific depression that it can come out of. So you have a little bit of just depressed price, which is the other part of the triple play. But then you see projected dividend yield. I'm right a little above the consensus, but in rough line. And then I came up with 14.1% return, and the consensus return on Manifest, if you check today, would be 16.1. Wrapping it all up, that was a relatively simple walkthrough based on history and my comfort level with high-quality management. That wasn't based on a whole lot of external factors. I did my stock selection guide very similar to the way that we just walked through it, and then tested it against the Manifest consensus, found it to be very reasonable, so I'm very comfortable with picking MSC Industrial. And if I could use 10 seconds, I would like to plug the Sacramento Breakfast of Champions coming up on February the 21st from 8 to 12. You can get some details on the Better Investing Sacramento chapter website, but I will be out presenting very much of a manifest-oriented growth stock investing, better investing presentation, talking about what growth is and how you can use it, focusing on total return as opposed to some of the other value criteria that we use at times, and then managing your portfolio on a portfolio-centered basis rather than individual stock basis. So MSC Industrial is my pick for the month.
Thanks, Si. Good stuff. All right, let's go ahead and switch gears into the technology sector, and Ken is looking to double down on Google. Ken, do we still have you?
Yes, you do, if I unmute. Can you throw the screen to me, please, Mark?
I can do that. I think I can do that.
Okay, are you seeing my screen? It says Roundtable on it.
Hold on, I lost my setting here.
All right. Well, I'll start here, even though the screen hasn't come up. Here it goes. Okay. If you came to last month's roundtable, this screen looks familiar to you, except I've added January 2015 to it, and I'll remind you again, my choice for the month again is Google. Google's mission is to organize the world. And if you want to see a very detailed philosophy, I'd urge you to go to their webpage. This is one of the few companies where I can read a philosophy point by point by point and then see exactly what they think they're doing to meet that point of the philosophy. The company does operate in 3 big business segments: Google sites, network sites, and other, and more than 80% of its revenue comes from internet search. That might be a strength, and it also might be a weakness for the company going forward. This slide's been revised since last month because Google just reported its end of fiscal year numbers. It's interesting that 60% of all search in the world happens through Google. Other competitors, nobody else does even 10% of the search business. There are 500 million Android devices. That number is growing very quickly, and 90% of the search on any Android device is using Google. Google invests extremely heavily in research and development. That number in 2014 grew by 33%. So this is a company that's very serious about creating new product and staying on the cutting edge of technology. Over half of their business is international, and a brand new fact that came out with their end-of-year report is that the foreign currency fluctuation impacted their earnings by about 3.4%. Many of you know that the dollar is much stronger than it has been historically, at least in the last 8 or 10 years. And the foreign currency being weaker has impacted Google's earnings to the downside by more than 3%. I've updated the information coming from Value Line and Morningstar. There has not been a new Value Line since December, so those screens are the same. But there has been a little shift in the safety rating and the timeliness rating. It's rated 1 for safety, 2 for timeliness, with an A++ financial strength. Morningstar gives this company a wide moat. And what that really means is that Morningstar says that the barriers to competition are really pretty strong, and that any other company would have a very difficult time competing head-to-head with Google and changing very much about what the company does. Now, that being said, Facebook and many other companies are taking a run at certain parts of the search business, and that 80% of business being done through search by Google might be up for a little bit of challenge. Google is going to have to grow in other areas, and those other areas aren't going to be quite as highly margined as the search business, and that might cause some issues down the road. You can see that Value Line says they expect revenues to grow about 14.5%. Morningstar suggests more than 12%. And if you look at different sources, Manifest suggests maybe 15% as a consensus number for growth going forward. Now, Google trades under 2 tickers, and there's been a recent split within the last year, and I'm going to go into that split and then tell you which of the 2 stocks I would buy and why. But if I look at the Eagle for Google, I see that the price in December when I presented this stock a month ago was $537.31, and I compare it to Friday's closing price of $537.55. So this Eagle is probably good enough for me to continue until the new numbers start to fall into all of the data, and the data catches up to the report. And the report just occurred, I think it was on Wednesday night. It might even have been on Thursday night that the report occurred. I wish I would be recommending Google 2 days ago before it jumped about $24 in price. That's 5% plus growth there. And when we bought Google last month, there were all kinds of questions on which stock are you buying. Are you buying the Class A shares or the Class C shares? So let me give you a little bit of history about what happened in that stock split. Google decided over a year ago that the founders of Google, which control more than 50% of the company, that their influence in the company was being diluted because their voting shares, which were Class B shares, were being diluted by the fact that many more Class A shares were being created to do all sorts of interesting things with the company. Google said, what we're going to do is we're going to split Class A, and instead of giving you twice as many Class A shares, we're going to match however many Class A shares you have with a new class of stock called Class C, and it'll trade under the ticker GOOGL. Now, the Class A shares, it'll trade under the ticker GOOG. Now, am I doing that correctly?
Mm-hmm.
Yes, okay. So what the company essentially did was they said, and certain of these shares, the GOOGL shares, will have voting rights, and other shares, the GOOG shares, will not have voting rights. Well, that created an uproar with activists throughout the country, and I went to the Wall Street Journal, and I got this what the Google stock split means to you kind of listing right here. Basically, what's happened after the activists finished doing some lawsuits around the stock split is that Google agreed that every time it sells a share of GOOG, it'll also convert a Class B share into a Class A share. It also said that they're going to compensate non-voting GOOG investors if there's a substantial difference in stock price between the two classes in a year. NASDAQ decided to put both shares into the NASDAQ 100, so that means for a while there were actually 101 constituent stocks in the 100 stock index, but they stopped doing that on June 23rd last year and began to only list the Class C shares going forward. Now, what does this all mean to the average investor? Because it's enough to make your head spin all around twice and then stop in the wrong position. To me, I don't think it has any meaning of any kind. Frankly, I'm not going to own anywhere near enough Google stock to worry about voting rights. It's a $500 plus share of stock, and in my world, if I can buy 50 or 75 or 100, I'm spending big money. Even if you're really spending big money and you can buy 1,000 or 2,000 shares, I don't think you're really going to impact voting by having voting shares versus non-voting shares. My philosophy is they're essentially the same thing. So why not buy the one that's cheapest? So when I look at the current price, I'm going to recommend to Mark that we buy more shares of GOOG because it's about $3 cheaper than the GOOGL. Now, if you have other reasons for buying one over the other, frankly, that's great, but I don't think it's debatable. I think each person will make the decision based on what's important to them. I don't see much difference in the potential return for either type of stock. In fact, the cheaper one will give me slightly more return. And here's a graph of the cheaper one. Mark, we still have to handle the split in the green bars right here. But essentially, I love to buy a stock when the quality stays consistent at a high level, and when I'm trading at a historic place that's probably higher than it's been par-wise over the last couple of years. I have to go way back to November 2012 before I see a higher price for Google. So I think this is a stock that needs to be in any portfolio, or at least something like Google needs to be in any portfolio. And so I'm going to recommend we put a little bit more of it in our portfolio. You can take the screen back, Mark, and we'll continue then.
Okay, thanks, Ken. And we'll maybe address a few questions on that in the Q&A session. All right, let's go ahead and, again, we talked a little bit about big tools and infrastructure and that kind of stuff, and the need to move dirt around. Let's let Hugh take us away with a repeat selection of Caterpillar.
Yeah, so I'll go through the process again. I'm not going to talk much about Caterpillar. Mark wanted just to chat a little bit about screening, so I ended up putting a few slides together and realized they were going to take up most of the time. So I'm going to look at Caterpillar, and if we bounce to the next slide, I'll just go through the thing that I do regularly every day as I look at what's going on with companies that I either own or I'm interested in owning, and to see how they're doing price-wise. How close are they to their 52-week low, and the closer they are, the better. And so right now, QUALCOMM is right at the bottom with Caterpillar following up, at least at the closing market yesterday. And going on to the next slide, it's just a quick graphic to show if you had a ladder stretching from the 52-week low to the 52-week high. When it's at the high, it's 100% of the way there. When it's at the midpoint, obviously, it's 50%. But I want it, as it will show in the next slide, to be closer to the bottom, maybe within 10%. Sometimes I'm looking under 25%. Right now, there are a lot under 20%. You can see them in green on this list. And I add some of the statistics from Manifest Investing in this chart, where it shows quality. QUALCOMM has the highest quality rating you can get, and the projected annual return. So looking at this list, the company that I selected out of it was Caterpillar. We'll talk about that in a moment. But if I go on to the next slide, it shows the bottom of the list, which perversely are the companies that are closer to their 52-week high. And right now, Sigma Aldrich is, and it will be for some time. It's getting acquired by Merck, the German Merck, not the U.S. one. And that company will disappear in June, much to my chagrin. It has been a very nice part of the portfolio for a long time. We'll chat about that in a moment. But it is close to its 52-week high. Staples is up there too. We mentioned that earlier. It took a nice bounce recently after lulling for, well, it seemed like years. So on the next slide, we just solidify things. We all wanted, by the way, to pick QUALCOMM, and we were talking about this earlier offline without Mark, but, you know, thought Mark needs the help for his total return, so we all decided to back off. Anyway, we can buy it if it gets cheaper than it is yesterday, so it's a win-win. So moving on then to the next slide, I wanted just to talk about screening and why we do this and how it can help. Obviously, our ultimate goal is to be substantially better off in the future than we are today, to have more financial assets. And for the financial assets that we do buy, for them to outperform or perform well over the long term. And I guess future implies a time horizon, so your criteria, as I indicate on the next slide, will be very different if your time horizon is the proverbial seconds or 25 seconds for a trader versus 25 years for a long-term investor. And as we go to slide 35, I have that right up on the top. But if you have a long-term time horizon, you can buy out of favor companies. You can buy companies that look quite ugly today, as long as you're assured that it's a quality company, that the engine for generating earnings will continue to drive the company for the next long period of time. And it also allows you to, what I call, ignore these diversification bullies. I want to be diversified, but I don't see any reason to be diversified today. I mean, if you were diversified, how often do you have to adjust things? Is it every month? Is it every second? How and why should you be diversified today when really what you're trying to do is to build a diversified portfolio, at least in my case, many years in the future? So it allows you to be the proverbial good Samaritan and buy those companies that are wounded temporarily for some reason and out of favor and have a lot of headlines around them saying why it's a bad company or why things are bad today. People like Jim Cramer are very good at doing that for you. So people run away and the price drops as a result. So you can get a quality company at a low price. And of course, the nice thing about time is it does neutralize risk. It's something that gets away that variability. And so you buy a bad company today, once the stock price has gone up 10 or 20-fold, if it's trading at $25 versus $30 today, looking back at that company many years in the future, you won't see the difference. So we go on to the next slide. An interesting idea is that to be a successful investor, you don't have to be right all the time, and you don't have to be right even most of the time. You can be right some of the time. When I look at my portfolio, and I think many of us share this experience, there may be a lot of companies in it, but a very small percent of those companies, in my case it might be 20 or 30% of the companies, make up the bulk of the return. And as these companies do well, you tend to add more to them when the prices decline. And I would argue that even though I own a lot of companies, I'm not really that diversified and really never have been. But I'm getting more diversified over time. So you end up you keep feeding the winners. And in investing, you really can be wrong most of the time and still have a near perfect score. And a perfect score would be beating something like the S&P for many people. The ultimate personal score is to be financially independent when you need to be. So moving on to slide 37, you're really looking for a financial thesaurus. Many people in the 90s talked about buying the next Microsoft. So you really have to find out what Microsoft looked like many years ago and what company fits that profile today. It turns out, of course, there are many companies that look like Microsoft did in 1986 before it went public. The problem is that most of them go away over time. Buying the next Microsoft can be the kind of risk that I would certainly not even embrace. Many have their own criteria for picking companies, but we're looking at a quality company at a good price. And the Manifest Investing screen is stupendous for doing that. And I complement it, obviously, with the stock selection guide, which is another nice way to dig into a company. So moving along, what I'm really looking for is a quality company at a low price, and Benjamin Graham, the mentor for Warren Buffett and many others, including a guy called Irving Kahn that I don't think we've talked about much online. He's the oldest active investor on Wall Street. I think he's 109 years old. Actually was shorting stocks right before the crash of 1929. Most recently he's been buying GlaxoSmithKline. A very interesting character, and I don't think he gets enough attention. Walter Schloss was a contemporary of his. He got some attention, but obviously he got a lot more after he passed away. But it'd be good to look at Irving Kahn if we can before he leaves us. At 109, he's probably getting close to that point. I like it when bad things happen to good companies. And in the next line, there's a bit of a spelling error, but it's a friendly one. Emotion is your enemy when you're investing, but free is your friend, but fear certainly should be your friend. So you're kind of reversing the instincts that you have. If you view it like a Weight Watchers Club that we're doing here, you could say to yourself, yes, we have many of the criteria that a Weight Watchers meeting might have, at least that you can read about. But the fact is, we're trying to get fat. We're trying to be a huge, big, fat, bulging portfolio. That's our goal. Kind of the opposite of everything, including emotion being your friend, fear is really your friend. And moving on, the screen that I look at is it has to have a solid record of achievement. I wanted to have a better return on equity, and I look at ROE quite a bit. Carving it up is instructive, and we could do a class on that at some point to show how parts 2A and 2B of the stock selection guide fit together. Generally, a leading company does so with a lower percent of its capitalization as debt, so it's not necessarily debt-free unless it's a software company, but it has lower debt than its peers. Usually has a slightly higher profit margin and sometimes a slightly greater than slightly higher profit margin. And I want it, if it pays dividends, I want it to be stable, and I like it to be growing unless there are some exceptions like 2008 where GE and many other companies had to suspend it for a little while. Bank of America was forced to drop it altogether for a bit. drop it down to a penny. And I want it to be a customer-focused company because, after all, that's where you get your revenues. And without getting the revenues right, nothing else will work for you over the long term. So it should be dominant, stable, and predictable. And moving along, yeah, busy slide, but it's a gating process for me rather than a screen. It has to pass all of these things. And at that point, moving on to the next slide, I would look at manifest investing and particularly the stock selection guide. And the final thing is I want to buy it cheap. So it has to be a company where I can see growth into the long term. And the long term is greater than a 5-year projection. Many of us do. Projecting out longer than that gets tougher and a little bit riskier. But I want to own a company potentially forever, a long time. And to protect downside, I like to buy things close to a 1-year low. But if it's a large company, if it's a kind of a mid-cap company, prefer it to be closer to a 2 or even a 3-year low. And for the highly risky small companies, I like horrible thing to happen, but the fundamental quality of the company to be still intact. And under those circumstances, a 4 to 5-year low is something that I find appealing. So if it's a quality company with strong growth potential and a name that I would be surprised if it weren't around in 25 years, could get acquired, of course, and it's cheap, then that's when I buy. So skipping, I think, to the final slide, just in summary, I didn't talk a lot about Caterpillar, but I've spoken about it a few times. It's going to suffer. People aren't going to be making capital investments in infrastructure projects that they were. It's easing off, and Caterpillar has said that, but it has suffered. It is suffering. It will continue to suffer, and for me, with a long-term horizon, not a bad time to buy. And I think over the next 25 years, engineers will like moving dirt around, and they'll continue to like digging holes, and Caterpillar will be there to help. So Caterpillar is my selection for today.
Thanks, Hugh. I'm sure that's a repeat.
Yep.
All right, let's go ahead and wrap up. I think we're doing pretty good on time, and then we'll have our audience poll and open the floor for some Q&A. This is a little bit of a busy screen, but again, going to be available both on the Manifest Investing forum and the homepage, and then we'll make the screens available through a public article for those of you that want to reach out and get that. All I did here was take, I think we're up to 8 or 9, maybe even almost 10 screens, and just kind of through the companies that appeared most frequently onto this list, sharing some key characteristics from top to bottom. You can see the projected annual return. Again, that's the Manifest Investing long-term forecast. The ones in yellow are a little bit cautionary, perhaps too good to be true. The ones in green would be, again, not much of a stretch. You can see many of the companies that have been talked about here today. You can see our quality ratings. Again, blue being excellent companies in the top 20% of all companies, and there's some other companies along the way there. The Manifest ranking is a combination index of the return forecast, the PAR, and the quality ranking, where we basically equally weight them and take a look at those 2 key characteristics. And then the final 3 columns would be the 3 opinions of, first, the value line, low total return forecast for those that have a long-term forecast. The next column is the Morningstar price to fair value. Again, Morningstar and in the last column, Standard & Poor's, they basically do the same thing we do with the stock selection guide, only they stand on their heads and figure out what price would make their stock selection guide look good. They call that the fair value. And so the comparison of the current day price to that fair value is what we're looking at. So anything less than 100 would be a company that is potentially on sale. Anything above 100 would be something they would consider avoiding. So you can, again, just kind of scrolling down that list, you can see pretty good agreement top to bottom. Most of the companies that are listed here could be thought of as being on sale. Jacobs is kind of appealing to me, but again, it's kind of hard to beat Qualcomm and their recent price drop at the top of the list. So I did go ahead with Qualcomm, sticking with the one that was the consensus favorite.
Mark, before you get off that screen, we have a couple people that are not remembering what those numbers in parentheses are meaning. Could you say that just again for them?
Oh, just real quickly, I took the different polls, very much like the Associated Press or USA Today or whoever does the coaches poll for collegiate sports, and just basically assigned votes, weighted voting. So the companies that showed up at the top of screens get more votes, and then just kind of combined them all. Again, just like we would do for college football or college basketball. So Qualcomm is the Kentucky of college basketball.
So the list is ranked by most popular based on the screens we've talked about today.
Absolutely.
Great.
And we'll probably add a few more to it, but pretty close to the end. And again, just notice the number of companies that we've talked about. Berkshire Hathaway is more attractive than it's been in quite some time, even though they had a very, very successful 2014. All right, so here's a look at Qualcomm. Again, this is a company in a very high technology, a bit of cyclicality type industry, but definitely a growth company. Again, another one of those San Diego companies that Hugh talks about. If it's not Aguron, it's probably Qualcomm out there. And very dominant player in the chip business. Again, if you use a cell phone or know anybody who does, there's a 90% chance they're using a Qualcomm chip inside that phone, along with other appliances. They have a stranglehold on the 3G marketplace, the technology behind 3G platform for cell phones, and a pretty good chunk of the 4G market. So they basically get royalties. Another way to think about it is every time you see a cell phone bought, Qualcomm is getting 3 to 5% of the sell price in the form of a royalty. So that's where they make their money. They do a few other things, but they are an absolutely dominant player in this industry. And again, as far as up, straight, and parallel goes, pretty well qualifies across the board here. Here's a look at the profitability and the PE ratio characteristics for Qualcomm. Again, they're going to have their bumps on the net margin. Right now they're going through quite a test in China, where China is pushing back on some of those royalties, and that's where you're going to see in the press you'll be reading about resolution of that conflict and the potential impact that it could have. The other thing that has happened here in the last few days is they apparently have lost a fairly major contract to Samsung. They were selling their chips to Samsung for the new Galaxy 6 phone, and Samsung has gone with another provider, so the Snapdragon chip will not be used there. So you're going to see a little bit of impact. That alone was enough for Morningstar to reduce their fair value from, I believe, 80 to 75, and some others have followed suit. But again, we are talking about a relatively small slice of a much bigger picture. The China thing is serious, but I think it'll probably be vulnerable to an overreaction. I think that's what we saw with the $15 price drop. And again, we're talking about a company that is a gorilla. Look at the PE ratio, how it has declined over time. I think it's much like a plane coming in for a landing, looking for that level plateau. Anywhere in that 15 to 20 range makes a lot of sense based on the absolute strength of this company going forward. So again, looking at some of the stuff that will be under the microscope here in the next couple of months, certainly for the next quarter, I'm basically looking at a company that has a reasonable growth rate in the 14% range. Even if they do take a hit on profitability and the margins drop down to the 30 range, even a little bit less than that, this is still a very strong company. Fairly conservative average PE ratio for the long-term forecast of 16. You could even stretch that up a little bit. They do pay a modest dividend, but under any measuring stick, you can see this was done with the stock price back at 73 like it was a couple of weeks ago. The price is actually now down around 63, and the projected annual return, the longer-term return forecast, even after correcting and making some assumptions about the damage from China and the damage from Samsung, you're looking at a company in the 15, 16, 17% long-term return forecast range. Very high-quality company, very well-positioned, etc. Here's the Chronicle, again looking at the month-by-month stock price going back over the years. You can see the price drop on the far right. You can also see that the return forecast is at levels that has rarely been seen in the last 4 or 5 years. So it's back up at high levels. We like that. A very high-quality company, very consistent quality over time. One last slide just to demonstrate this company has speed bumps. It comes with speed bumps, and it's in the middle of one right now. On the far right-hand side, you can see the drop from up in the high 70s. It actually got up into the 80 range before it dropped back into the low 60s just this past week. But again, the long-term trend from left to right, again, echoing the theme made by others, including Hugh, you have to look beyond. They're going to do something with the China situation. They're going to continue to compete pretty aggressively in the field that they dominate. And I'll just leave you with one last thought. I did have the privilege of and a lot of fun of attending the Consumer Electronics Show, biggest trade show in the world, a couple of weeks ago in Las Vegas. And just to give you guys a feel for it, you're talking about probably 18, probably more than that, probably 50 football fields completely stacked with trade show booths and big displays. Well, Qualcomm had a couple of football fields all to themselves, along with Intel and a few others, but these guys are quite a presence in the field that they do dominate, and a lot of fun walking around, checking out some of the stuff that they're up to. And again, from the perspective of a very long-term trend, I like the blue line down there at the bottom. Forget the bumping around stuff. The blue trend is something likely to continue with this dominant and effective as these guys are in their business. So my selection, it'll be the 8th time we have selected Qualcomm. So it's one of the leaders in our tracking portfolio in terms of the number of times selected, but I see this as a buying opportunity for a very high-quality company that just happens to be rolling through yet another speed bump along the way. So Qualcomm will be my pick. So Ken, I think you can go ahead and launch the poll, and we'll get on with the rest of the program.
Okay, and Mark, after we deal with the poll, I do have one stock I'd like to talk about on the list. It's not exactly hot seat, but I'd like to talk about it if we could.
Okay.
And here goes the poll. Let's launch the poll. If you'll take just a moment, folks, and choose a stock to add to the portfolio. We have 2/3. We have 3/4 of you voting. We have 4/5 of you voting. All it takes is your mouse. Just move your mouse up. I'll give you about 8 more seconds to make a vote.
Do I get to vote multiple times this month yet?
You don't need to this time, Mark.
Okay.
And I'll close the poll.
Well, happy birthday.
And I'll share the poll with everybody. And there you go, Mark. You got to win, okay?
Woo! Well, you know, I'm probably going to turn cold now. I was red hot last year, guys, and you missed a lot of opportunity. More on that next month, by the way, guys.
We all have been in both sides of it now for the last 4 or 5 years, so we're all in good shape.
It's definitely a humiliating exercise. You know, by the way, that's a short commercial for our next roundtable. Will include a look back at results, and it's Hugh and Ken have taken away a lot of trophies in recent years, so we hope to slow that tide a little bit.
Amen.
You know, for me, it's always the last day of the year where it matters.
Well,
and
I noticed that.
Hugh told you that we had a meeting prior to the roundtable today, didn't he, Mark?
Yeah. Well, we all wanted to buy Qualcomm, but we said no. Let Mark win once. And as Ken pointed out, it make it cheaper, so we get to win anyway.
Mark, if we could just make a point to, I'd like to put a motion on the table to close the position on MWIV. And the reason is that AmerisourceBergen has made a tender offer for the company. If you folks take the time to show yourself a stock selection guide of MWIV, you'll see a poster child for Up Straight and Parallel. don't bother looking at the graphs for Amerisource Bergen. They're a poster child for not up straight in parallel. But this large company has bought this very small company. The tender offer that they're putting forth is at $190 a share, and I think the stock is trading at $189.70 something. I don't think we're going to be able to arbitrage those last couple of pennies out of there. So I think just to keep our bookkeeping all clear, we should close that position.
Yeah, I'm perfectly comfortable with that. My experience with this type of thing is if deals do fall through, typically the stock price goes back to these low levels that we saw here.
Yeah, absolutely. If in fact we, I think I have the poll thing showing. Yeah, wait, let me try to get rid of that here. Hide it. There we go. Now we should be seeing your screen again, Mark. Okay.
Yeah, and Ken's point is the prices run up on the takeout offer, and again, if that were to fall apart, we talked about this I don't remember the company, but about a year ago we talked about a company where the deal did fall apart, and the price basically went back to the low levels that it had seen in the last few years.
Yeah, and there's no reason for us to accept 130, 140, 150 when they're offering us 190 right now. So
yeah, the only time that it ever really would make sense to hold is if you're in a bidding war situation. I mean, even if in WIV we're contesting this, and are they?
No, they're not contesting it at all.
Yeah,
no.
Even if they were contesting it, if there's not another player. What Mark is saying is right. In my experience in the past, even if the company wins, you're going to go back somewhere near the price, so you end up rebuying it. But if they're not contesting it, then and there's nobody else out there bidding right now, nobody's going to show up. So let's take the money and run.
It's exactly, two of my investment clubs own this stock. It's the same debate we had. Let's take the 190, and if the deal falls through and it goes back to 150, we love the company, we'll come back into it at 150 then. But I don't think there's much of a chance of this particular deal falling through.
Okay, well, unless there's any objection, we'll just go ahead and close out that position, report it, and take the money and run.
Yep.
Okay, I think with that, Ken, why don't we do an official close down, and we'll stick around, open up the microphones, and see if anybody else has any questions.
Okay, well, that marks the end of yet another roundtable. We're always happy to have all of you from around the country, and especially you folks from mid-Michigan, and we'll be announcing future roundtable dates within the next week or 10 days. Watch the Manifest Investing site. And Natalie will be notifying everybody in plenty of time so that you can get registered for the February roundtable. Thanks, everybody.
Yep, thanks, everybody. Enjoy the Super Bowl.